Well, it's great to be back for session two in the trilogy Navigating a New World. And we're talking about navigating the world of investing for now and for all of your financial future. Now, I am expecting, hoping, wishing that you have all seen the first session. When I say all seen, for those who are watching this, uh, this was originally recorded for graduates at Western Washington University as a special course. As a matter of fact, a series of teachers, instructors, professors, whatnot, spent time sharing information that we all think is instrumental in navigating this interesting, exciting, and daunting new world they're going into. So, in the first session, and that session was all about 12 simple ways to supercharge your retirement. We didn't mean you were preparing to retire tomorrow, but how to supercharge it when you retire in 20, 30, 40 years, and then how you use this money in retirement, investing wisely for yourself and for those who survive you. It's all very simple. Every one of those 12 decisions, if you didn't see it, I hope you will show you how to make an extra $1 million towards retirement and again, your legacy. But in this particular presentation, I want to focus on one of the 12 because of all of the 12, this is the one that is likely to benefit the most investors because this is what I consider and many others consider America's number one retirement investment, and that is the target date fund. So let's explore where it came from, what it does, and why and how does this one investment wrap up most of those $1 million decisions. Let me give you a little history, get a perspective of where this target date fund came from and why it is so powerful. Really, the beginning of this process was the mutual fund, followed in later, many years later, by the index funds, and finally the target date fund. So these three are the great moments in investment history in terms of what is being done that is in your best interest. So let's first, just for a few minutes, talk about mutual funds. First mutual fund was set up in 1924. It was not set up for common investors. It was set up for the children of wealthy investors. And the challenge was, how could they give guidance and advice to the children of these wealthy people? You see, with the wealthy, they might have multi-million-dollar requirements to hire these high-priced managers, but the kids didn't have that kind of money. So they created pools of investments so that they could bring together a number of different people. And that leads to what we know today as the mutual fund. And what made them so amazingly powerful is that literally, and today this is so, literally, with $100, you can get the diversification of a multi-million-dollar investment. Literally, you can have as many companies. Oh, by the way, you'll have very small pieces of as many companies, but it is all pro rata. So that if the wealthiest make 10% in this mutual fund, so do the smallest accounts. And talk about low, small accounts, the minimums can be as little as nothing. I mean, well, you got to have $1, got to put something in, but you don't even have to have $1,000. You could start with $50. and be treated like a rich, wealthy person. And the beauty, one of the very many highlights and advantages of the mutual fund is you have 1 day liquidity as long as it's during the market week. On any day the market is open, you have the right to say, I want my money back. Now, not the money you put in necessarily. It could be a number that's very much higher. It could be a number that's very much lower. We don't know that, but you can liquidate your shares. And you can, in most cases, liquidate without any kind of penalty. It is an amazing investment when you think about it, because it literally does take, in order to build a similar level of diversification, millions of dollars of investments if you do these one stock at a time. But when you buy the mutual fund, you get it all. And then what happened was mutual funds built families of mutual funds. So under one umbrella, like at Fidelity or Vanguard or Schwab or TIAA, and many organizations now have 10, 20, 30, maybe even 200 different kinds of mutual funds. So if you want to be aggressive, you want to be conservative, you want to be middle of the road, you want to be big companies, small companies, you want to invest in international companies, you want to be in just a sector, you only want to be in the airline industry. Mutual funds are set up to allow you to do that. And so it is and remains to be an amazing investment. Then it wasn't until 1976 that we had another opportunity to make a breakthrough that I would say was truly life-changing. Now, when I think in terms of life-changing, I am either talking about legal protections somehow that you could have by whatever the change is, or simply that something has happened that suggests that you should make more money in the future than you would have in the past. And this mutual fund, what they call the index fund, was developed by a fellow named John Bogle. Now, he wasn't the first one to develop a kind of pooling of investors that would own all of the stocks, couldn't pick the best ones. You didn't get to throw out the worst ones. When you owned the S&P 500, you owned all 500 of what were or are approximately the largest public companies in the United States. So most money management up to that time, in fact, virtually all, was based on somebody saying, I know how to pick stocks. I not only know how to pick them, I know at what point we should be in, and I know at what point we should be out. People love that. Smart people taking care of your money that would be able to get you in and get you out at the right time and be in the right issues. It's a path to risk. But the problem was that the studies showed that was not what was happening. In fact, the studies showed, prior to there being an actual index fund that the public could put their money into, the studies showed that owning all the companies was doing a better job of serving the investors than owning some. Because it turns out, and this will not shock you, and yet still a lot of people believe this, nobody knows what's going to happen next. Nobody knows what companies are going to be the stars over the next 25 years. I can tell you they know the stars of the last 25 years. See, we always know what we should have done. There is no risk in the past. That's an important concept that you should know. And so what was discovered was that by owning all of the funds in the S&P 500, not only could you provide it at very low cost compared to having those very expensive, very smart people, but because they weren't buying and selling The portfolio is more tax efficient. You pay less in taxes, more in your pocket, less in the government's, and more in your pocket, less in the money managers, and more for you in the future. Compounding. We know the magic of compounding. Well, the more that's left in there, the lower the expenses, the better the return, the less taxation you have to pay, the more is going to be in your pocket. And so mutual funds that were built like index funds now had something that nobody else had. John Bogle, in essence, had a monopoly on the concept of the public index fund. But the fact is, when it came to the public in 1976, they were expecting on the original initial public offering to raise $150 million. There was so little interest that only $11 million of this fund were subscribed. And at one point, the trustees almost decided to give the money back to the investors and send John Bogle on his way to do something else for a living. But he convinced them, give me time. And as is so often right in this industry, the investment industry, the right thing often takes time to prove itself. And boy, did it prove itself. He went from being the manager of a fund that they called Bogle's Folly. He was the laughing stock of the industry. Well, they wanted you to think that way about him, because if in fact his beliefs were right, then how would they compete against an index fund? Well, it turns out, since over half of the money today that goes into the stock market and the bond market goes into index funds, they were right to be afraid. But it took time. And even though for the first almost 25 years of its existence, it compounded at over 17% a year, because remember, an index fund is not trying to beat the market, it's trying to be the market. And it did be the market, and it was a period the market compounded at 17 plus, and so did the index fund that tracked that index. And the other part that's really quite interesting is the expected rate of return of a mutual fund that is cheaper is expected to be higher. That's good, because you're paying lower fees. And the index fund is expected to be better because it owns more companies. Studies show that the more companies you own, the more likely you are to achieve your long-term goal. So there was a number two, the second most important investment I think ever developed. Now, I'm not saying there weren't other changes in the industry. There were, but most of those changes had to do with regulating the scoundrels who were running the business. They developed trading regulations. They developed disclosure regulations that had been used to, let's just say, I don't want to say necessarily always bilk people, but really did not act in the best interest of the investors. And it was at about this same time that Bogle started this first index fund that Charles Schwab, you know, the Charles Schwab and Company, they came out, they introduced lower commissions. Commissions became unregulated, and they cut the price, and that they kept cutting the price. And over time, everybody had to cut the price until today, as you may know, many of you are trading securities without paying a penny in commissions. So that was another area where investors were helped, because less money was in the pocket of Wall Street and more money was in the pocket of the investors. And then the third and the powerhouse And it's interesting because basically all the target date fund is it's a mutual fund. So that's been around since 1924. And many, not all, but many, and the ones that I think are the best for the long term, are built on index funds. So you've got two powerful instruments, in a sense, working for you. But what they do in a target date fund is likely one of the most magic answers, one of the most productive answers for investors, because what they do is they treat you and they take care of you to make sure that you are invested the way that you should be, with the right amount of equity, with the right amount of fixed income. And how do they know to do that? Do they know who you are? Well, they don't know who you are. But when you invest in a target date fund, you know when you want to retire. And so you simply put your money into the target date fund that is set for people who want to retire around and about 2060, 2065, 2050, 2045, 2040. Every 5 years, you can select a different retirement date. And that means that if you put in, you want the target date fund for 2065, that you have many years to retirement, and you should have most or maybe even all, I would say all, but many target date funds still have some money in bonds, but you're going to be mostly in equities for growth, which is what you should be. And there are a lot of people afraid to go into equities because they're not sure what to do. They don't know which equities, they don't know which mutual fund. But if you're in a target date fund, they'll take care of that for you. And maybe the very thing that you're afraid of, if you know it's in the hands of a professional manager, will give you the confidence to do that. And so that's what the target date fund does. It decides what equity, stock, mutual fund should you be in. How much should be in US? How much should be in international? How much in large? How much in small? How much in growth? How much in value? Many of those things we talked about in the first session. And as you age, and you should become, eventually anyway, more conservative. I'm 77. My portfolio is 50-50 stocks and bonds. Your portfolio at 21 could be all in stocks and no bonds, or 90% in stocks and 10% in bonds. But the point is, you can afford the risk. In fact, when you are young and the market is in decline, you benefit by being all in stocks because you don't have much money in the market. And the money that you are putting into the market is buying less expensive shares as the market goes down. It's a huge benefit for the future. And the very thing that is hard for the individual to do, the people who run, the professionals, they know how to do that. So target date funds are a way within a 401k plan in particular, where most young people, if they are putting away money for retirement, are going into the company's 401k, or it could be in a nonprofit or an educational institution, could be a 403b. They're basically the same. But in the 401k, many 401ks, when people start, they default to target date funds. That's where they will put you, because that's where they believe you are likely to be handled and managed in your own best interest. So here are people who know the stocks to buy. If you get an actively managed target date fund, they're going to think they know when to buy them and when to sell them. If you get an index-based target date fund, then you're going to be basically a buy and hold committed investor, but there will be a focus on how much in stocks and how much in bonds. And in the stocks, how much in large, how much in small, and all those other equity asset classes. Now, here's the wonderful thing in terms of understanding what's being done for you. They tell you when you're 21 how they're going to handle the money for the next 80 years if you have them do it for you. So at Vanguard, and this is called the glide path for a target date fund. If you're not in a target date fund, you should still have a glide path, knowing over time how are you going to determine how much in stocks and how much in bonds. And if you wanted to build your own target date fund, you could use the Vanguard, or below Vanguard here is BlackRock, another family of mutual funds that do target date funds. So you can see here for the early years, the orange is all fixed income bonds. Remember, bonds are the brake. The blue, the stocks, that's the gas. That's where you're supposed to get the growth. So you'll notice about 25 years away from retirement, notice the 25 here, 25 years away from retirement, their target date fund starts adding fixed income, more orange. And here at about age 70, they get up to almost 70% in bonds, 30% in equities, and that's the way you stay for the rest of your life. And by the way, that's a very low risk investment historically. If you are familiar with our fine tuning tables, and if you're not, I hope you will become. You go to Best Advice on our homepage, and it will show you, give you access to the fine tuning tables so you understand the risk of these different combinations of stocks and bonds. So it's a plan. Everybody says that the best path to long-term success is to have a plan. Well, in essence, when you put your money into the Vanguard or the Fidelity or BlackRock or Schwab or any of these other target date funds, you have a plan. You have a plan for when you should be in equities, when you should be in bonds. You have a plan for all of the important decisions. The only one those people can't take care of, that can't put a gun to your head and tell you to save. You have to do that. But everything else, even after you retire, can be taken care of. And my experience from working with young people is sometimes they like to feel pretty cocky, like they got it going, they understand all these kind of things. After all, they have got a degree now, so they're supposed to know this stuff. Now I know better. Not many people really understand the investment process when you're 21 years old, but you can do this. You can be smart enough to put it into the hands of somebody who is an absolute professional, responsible for literally trillions of dollars. So the reason I wanted to show you these glide paths is they can be very different. For example, here I am at 75, and if I were at Vanguard, I would be in 30% equity. If I had my money with BlackRock, I would be in 40% equity. As it is, I'm in 50% equity because I have more risk tolerance. Target date funds, an investor's best friend. By the way, that in essence, emotionally, is why I believe the target date fund is such an amazing investment for young people. By the way, I feel the same way for older people as I do for first-time investors. And the reason I think a target date fund is, I'm going to say, almost your best friend, is because they do take care of almost all of the things that have to be taken care of. There are some things they don't do, or as you know in life, there are sins of omission and sins of commission. And sometimes their sins are of commission, and sometimes their sins are of omission, and I'll explain that in a second. But here is why I really like the target date fund. I suspect you all know what a pension plan is. Maybe your grandparents had a pension plan. Maybe your parents have a pension plan. They go to work for a company, they work for them for 30, 40 years. And then when they retire, they are guaranteed a monthly income. Well, that money that went into the pension, in a sense, it was just part of the pay, the salary that the person that was working for them had received, but they never got their hands on it. You see, today with an IRA or a 401k that you can invest for the long term, much like a pension plan, today you have to make all the decisions where that money goes if you decide to put the money in. They're not going to force you to. But the pension plans were like parents, grandparents. This will be good for you. You will be happy we did this, because you will have guaranteed income that will make you feel very secure when you get to retirement. That's how pension funds are run. It's the employees' money, but they don't get it till later. And it's managed professionally with no input. You can't call up the pension trustees and say, you know, I'm feeling really uncomfortable with the market these days. Could you please sell all of my securities and put them in a money market fund? No, you don't get to do that. They don't let that. It's you can't get at it. You can't tell anybody what to do. With the 401k, you can liquidate any day you want. Go to cash, get safe, feel better, maybe feel safer because you got out of the market when it was down 50%. You got out. You didn't want to be there when it went down another 50%. So you got out, got into cash. I can guarantee you the people running those 401k plans did not liquidate. In fact, they were continuing all the way down to not only hold, but to buy more. Right thing to do. We know that for the long term. But remember, when you get closer to retirement, you got a lot of fixed income in there. And you never, ever, ever have to second guess the market. That's what I was talking about a minute ago. And rebalancing your portfolio. You've probably read about there's a time to rebalance, take some stocks, money out of stocks, put them into bonds, because your 50-50 portfolio is now 60% in stocks, and that's not what it's supposed to do. So you rebalance. They automatically do that for you. And here, I think, is the really, really great news for the future. And I've said it many times. I'll keep saying it. When I say for the future, that's only based on what I know about the past. And what I know about the past, and what the people who did Wharton did a study of 1.2 million 401k plans at Vanguard. The people who had all of their money in target date funds, compared to the people who had no money in target date funds, were built, those with the target date funds are expected to make 2.3% more per year. Now, think about that. If you were with me in the last session, I was jumping up and down and celebrating if we could ever find an extra 0.5% because that should lead to $1 million to $1.5 million additional dollars in retirement from what you would have had if you didn't pick up that extra half. Well, now we're talking about 2.3. I mean, think about that. 2.3, that's like over 4.1/2%. That's life-changing. And you don't have to do anything but the saving. So I sound like I like him, and I do like him. But there are some things that are wrong with them. Now, when I say they're wrong, they would be wrong for me. They might be totally right for you. But I will tell you the reason that they would be wrong for me is because with taking over time very little additional risk, you have an opportunity to make $2 million more, $2 million more because they are built to be so conservative. And I'm not against conservative, but if you understood why it would make sense to take at least a little bit out of your money and invest it a little more aggressively, that it would be in your best interest. And the first one, the thing that it really does drive me nuts. And when I actually had a meeting in John Bogle's, the fellow who started the Vanguard funds in 2017, I flew back to Pennsylvania from Seattle area, and I went back there for one thing, and that was to have a 1 hour meeting with John Bogle and have a chance to talk with him before the end of his career. And he did. He died a couple of years later. So I felt fortunate, really fortunate, to have more than, in fact, he gave me 90 minutes, and it was wonderful, wonderful education and motivation for me to help others learn what he told me. I learned something from him that I think is quite important. But I also learned why, Mr. Bogle, do you have young people's money, even if it's only 10%? Because for every 10% that you have in a bond fund, you reduce the rest of the portfolio. If the rest is in equities, you reduce it by 0.5% a year. Well, as last session says, I'll look hard to try to find you another 0.5%. And so why would you put those bonds little bit? I mean, if the market goes down, you're not really protecting that portfolio very much. Instead of going down 50%, okay, you go down 45%. It's not like you saved them from a bear market. But their point is this: we are trying to educate these people for a lifetime that when you work with us, we are going to have your portfolio balanced with equities for growth, for bonds, for stability. And so we're going to start with a little in bonds. And we're going to have those there as a base of some stability. And if they were honest, they would tell you it's going to cost you 0.5% a year. But they don't do that because people don't go out of their way to tell you the things they're doing that are going to set you back. Because you probably say, hey, I want all equities. But when you get to 40 years of age, they start adding more and more bonds. So it is to get you acclimated to the bonds. Well, I'd rather acclimate you to an education, how investing works in your best interest. So I don't want bonds in there when you're 20 or 30 years old. Even 40 may be questionable. It might be good to wait till 45 or 50. That depends on the individual. I'll tell you what else is wrong. Some target date funds are actively managed. You know how I feel about the index versus active management. I want you to take advantage of all of the benefits and advantages of index funds. The fact that people want to make more money off of you doing something that they all know is unlikely to do better than the index funds is the way life is. Okay, you don't get full disclosure in the world like you'd like, but I don't want you in actively managed funds if I could be there to guide you. Those actively managed funds have higher fees. That's one of the reasons I don't want you in them. Another reason is they're not as diversified as the index fund. I want more diversification. Even if we didn't make any more money, it would be a less risky strategy or portfolio to have thousands of companies rather than 200. And we know that target date funds are not likely to beat their benchmark, but the closest they can come to the benchmark is likely to be with index funds as the base of the investment. The other thing is these are maybe small things, but you see, the retirement date isn't the only important variable. They don't know how aggressive you want to be. They don't know about your risk tolerance. They don't know that you're a trust fund baby. You got money elsewhere. You don't have to worry about your retirement. You can be more aggressive. Maybe as many people are, many people are absolute buy and hold all equities for their entire life. And so these strategies are not going to be right. And target date funds normally only have one level of risk. We'll call it conservative. Above conservative is moderate, and above moderate is aggressive. And I think someday what we'll see are offers of conservative, moderate, and aggressive target date funds, so that people who invest to retire in 2065, some will have no fixed income until they're 45. Some will have no fixed income until they're 30. Some will have 10% bonds until they're 40. You could do that so easily and give people that choice. And almost all target date funds, and this isn't just according to the Merriman Financial Education Foundation, this is according to almost every academic that has looked at the implications of having value in your portfolio and small cap, value and small cap. We want you to have those asset classes, just like we want you to have the S&P 500. And there are other asset classes we want you to have, but these two asset classes, value and small cap, are both very powerful historically. And I just want to take a minute. You saw this in the first session, but I want to circle back here for a second. This column right here, US large cap blend, that basically is the S&P 500. I just want you to notice that $100, the average 40-year growth of $100 with the S&P 500 was up to 6,441, or an 11% compound rate of return. If you had money in large cap value, it was 13.5% instead of 11. That's an extra 2.5. And instead of 6,400, you get over $15,000. And then for small cap blend, almost $17,000. And then for small cap value, $40,000. And then, by the way, as we will talk a little bit more in the next session about, all four, some each of small cap value, small cap blend, large cap value, and large cap blend, the 4-fund combo, $100 grew to $17,315. That was versus 11, 13.8% compound rate of return, almost 3% more per year than the S&P 500, with very little additional risk. So I want people to understand that. If they choose, they don't want even a little bit more risk, fine. But I at least want you to know it is something you can choose. So what can you do to overcome the weaknesses of these target date funds? Because you do want a target date fund, or you want the strategy to be a target date fund like strategy. One thing you could do is you could build a custom target date fund. You could go to Vanguard. They tell you exactly what is in the target date fund in terms of how much in bonds, how much in US stocks, how much in international stocks, what US stocks, what fund would you want to be in US stocks, what fund would you want to be in international stocks, and what bond fund. They give it all to you. You can build it yourself. And in fact, when you do build it yourself, there's really two things that benefit you. You get rid of those bonds when you're 20 in your 20s and 30s. You pick up that 0.5%. Plus, when you buy those mutual funds or exchange traded funds, that's for another day, but they're basically the same as a mutual fund. When you build it yourself, you get lower internal expense ratios than in the target date fund. Well, it's not a lot, but even 0.05% is going to have an impact on your retirement and on what you leave to others. The other thing you could do to try to cushion the blow of having those bonds in there is put a whole much more stock in there. You could put half of the portfolio, you could put into stocks, and you could even balance it the same way that they have the equities balanced themselves in the target date fund. And what that would mean is that the bonds become a smaller part of the portfolio. What do you do about too little in small cap? You could just add small cap. You could do that. You could put 90% into a target date fund and 10% into a small cap fund. You could even put 10% if you wanted to in a value fund to increase the amount of value in the portfolio. Or to make it really simple, you can buy a mutual fund that exposes you to value and to small. And you can add one fund to the target date fund. And you can do it in a way that will get you where I think you should be going in terms of exposure to these other asset classes. We are so unbelievably fortunate to have a team of very experienced people working for our foundation when it comes to helping to build portfolios that we believe are in your best interest. And the director of research, Chris Pedersen. Chris joined us in 2016. Not only is he very smart and very clever, but he also works for us for nothing. He's donating his life that he doesn't donate to his wife and family and other things he does. But he has worked hundreds of hours each year at no cost to our foundation, as has Daryl Balls, our director of analysis or analytics, excuse me. And Daryl is the one, if you've been to our website, there's over 100 tables there for people to be able to review and put to use for understanding the process. And Daryl is the one who's built all those tables. But Chris Pedersen, boy, talk about a home run. Chris set out to do two things. He set out to try to build a portfolio with no more than two funds. Keep it really simple. Now, he knew a target date fund was one fund, a great fund, but he also knew of its weakness, and he wanted to do something to overcome the weaknesses. And we could get everything else. We could get the index funds, we could get low expenses, we could get massive diversification, all the equities and et cetera that we want to in that fund. But we had to do something about the small and the value. So he built a two-fund portfolio that you can approach two ways. Now, I will tell you that he has a new book coming out in the next couple of months that will show an even additional way. And it's the book is entitled Two Funds for Life, and the proceeds all go to the foundation. He's not making anything on the book. As usual, he's just trying to help people do better with their investments. But let me tell you about the two. When I say the two, in our book that's free to you, the 12 simple ways to supercharge your retirement that you all have access to with a PDF. And I'm hoping you're going to pass it along to family and friends free. We spend about half that book explaining 2 Funds for Life. So while you're only going to get a relatively few minutes here, you're going to get lots when you read that book. And on our site, our website, if you go to twofundsforlife.com, number 2, then what you'll see is you'll see an interview where Chris and I have done, and articles we've done, and all sorts of educational material to try to help you do the right thing for you. But let me take you briefly through these 2 ways to use the 2 funds. One is to be cautious, to be pretty doggone, at least in the early years, to do this, but I'm not going to try it with very much money. And so you could put 80 or 90% into the target date fund, so that every time that you made a contribution of $100, $80 or $90 would go into that target date fund, and $20 or $10, you could make it less if you want, would go into small cap value. Now, it could go into other asset classes, but for this presentation, I am just going to focus on small cap value. And that's, you do that. You do it for 5, 10, 15, 20. You do that for 40 years. Every time, 90% into the target date fund, 10% into small cap value. Now, it will take years for small cap value to catch up to the returns of target date funds. So this is not going to be a home run overnight, but you will see in a few minutes that it will add a sizable additional amount of money for you to have to spend and leave to others in retirement. The other approach is, and this is the one that is in a sense the home run, because it does the right thing. When you are young, you can afford and should take more risk. The small cap value asset class is more risky than the big companies. We've talked about that before in the first session and a little bit here. Okay. Now, the formula in our book is you just multiply your age times 150, 1.5. So if you're 20, 1.5 times 20 is 30, and you'd have 30% of the target date fund and 70% in small cap value. Then when you're 30, you'd have 45% in the target date fund and 55% in small cap value. When you're 50, you'd have 75% in target date fund. You see what's happening? As you get older, it's making it more and more conservative. And when you are 66 and you multiply that times 1.5, you are out of small cap value. Now, in the book, you will see the implications of keeping some, at least 10 or 20% of small cap value in your portfolio after retirement. But that's another block of time. So what happens there is you start with a lot of small cap value, go down to little or none, as opposed to the 10% or the 20% up front, instead of the 70% or 25, whatever, that you would with that 1.5 times your age. So the bottom line is that you will make similar rates of return with those 2 strategies, but you will have in one case more risk at the end than the other. So for people who are young, they should take more risk. They have many years for the portfolio to underperform their short-term expectations. And we've talked about this. In fact, in the last segment, I will show you some work with small cap value in terms of the history of its pricing. So my point is, there are two ways you can approach this. Let me just show you very quickly the implications. And just see how I'm doing. I'm okay. The implications of adding the small cap value. Let's start not adding the small cap value. How would $1,000 every year over 40 years, but each year you would add inflation, okay? So it's going to be, you'll start with 1,000. If inflation is 10%, then the next year it would be 1,100. And that would have grown to, based on historical returns of the way that target date funds are built and managed over a lifetime, and they used the Vanguard glide path, and we can test the glide path historically, it would grow to about, well, let's just say almost 700,000. If you put 10% in small cap value and 90% in the target date fund, it would grow to about 800 and let's call it 50,000. So 700,000 versus 850,000. If you did it with 20%, then it would grow to over $1 million. Now, this is just with $1,000 a year. You know, I'm always looking for an extra million. And I can tell you that over a lifetime, that the difference between the 700 and the 850 will end up during the distribution period of being, particularly when you do this with more than $1,000 a year, will end up being much more than $1 million difference. But notice this, a drawdown is how far down a portfolio goes before it goes up. You'll have market declines like 73 and 74 and 2000 through 2002 and 2007 through 2009. And in 2020, there was a very short-term decline of 34%. And by the way, in the next session, we'll talk about bear markets at some depth. But as you look at these different portfolios, the all just regular old target date fund, the worst drawdown that you could have based on the past at retirement age doesn't mean it's going to happen. But if the worst thing looking backwards were to happen to you at that age because of the amount of fixed income you have in there, the loss would be 26%. The odds are you're not going to see the worst drawdown at age 65. In fact, there's a small chance that you will, but you're likely to see some drawdown, some bear market in and around the time that you start to retire. And with the one that ends up with 856,000 here or 850, as we said, it was a 36% return. So this extra return that you got is not risk-free. They're never risk-free. And as you add more of the small cap value, the $1 million potential worst drawdown at age 65 is 44%. So the reality is that you take more risk and you do it with the knowledge of what that loss might be. If you decided there's no way I want to be part of this at age 65 and lose that much, well, guess what? You reduce the exposure to small cap value to be something that looks, if you want, more like the traditional Vanguard like fund. You can do that. You can do that. And here is the 1.5 times, and let me just look at small cap value. 1.5 times your age, and then the rest in small cap value. The final number was $972,900. So it was more than the 10% in small cap value, less than the 20% in small cap value, but it had a very low, almost target. Well, it would be like a target date fund because it's almost out of small cap value at that point. For those of you who are getting lost in this discussion, I do apologize. I am not a professional teacher. I am just a person committed to helping you as best I can. But when you read the book, I think it'll be slower. It will be easier for people, I think, to deal with. As I said, you can go to twofundsforlife.com, watch for Chris's new book. And here we are with the same ending in the second session as the first. I do again want to highlight, when you go to paulmerriman.com under best advice, it's the most important work that we offer in terms of studying the relationship between risk and return. The portfolios are set up to give you, whether it's Two Funds for Life or any of the other portfolios for Schwab and Vanguard and Fidelity, you'll find those portfolios there. And of course, some 700 plus podcasts and videos and articles. We are here to try to help you make more money. And as I said at the end of the last session, if you do go to paulmerriman.com and you sign up, you will get for our newsletter, you will get a free copy of the We're Talking Millions book that I talked about earlier. So what do you think we learned? Well, I would like to believe we learned that automating this whole process through target date funds is absolutely in your best interest. And you know something? I don't care how smart you think you are. I can look at the history and I know that most people get tripped up by the process of do-it-yourself investing. In fact, most do-it-yourself investors are doing something very similar to what we're advocating. I'm talking about the ones that have been around for a long time and gone through the process of getting it wrong for a while. I don't want you to have to make the mistakes that cost investors so dearly, because those early dollars are golden over the long term. And that's something we talked about certainly in the last session. So I think we also learned that there are ways you can join one or more different asset classes to that target date fund and increase what you have as the base at retirement by certainly 20 to 30%, which if instead of getting $1 million, you have $1.2 million or $1.3 million, well, that means you get to pick up an extra, let's say $15,000 in income annually, and an extra $200,000 or $300,000 that's continuing to grow for your family and for you in the future. I hope those lessons are valuable. And I think you can email me, paul@paulmerriman.com, and I will do all to try to answer your question. I don't get to everyone directly. In fact, I can't get back to everybody, but I do try to include questions that are general questions. I can't be your personal investment advisor, but we will answer them in our Q&As in our newsletter or on our website, in the articles we write, or on the podcast. We are here to serve. And I'll tell you, the price is right. And this is one of those cases where, you hear that if you get stuff that's free, you get what you pay for. Let me tell you, this free advice, whether there's the advice I give or other people that are given similar advice, it truly is life changing. Now, you get out there and change it. All the best. We'll see you in session 3, where we are going to be talking about managing the most important risks of investing. It's different information than in the first 2 sessions. I think it will be very valuable for you for the long term. Thank you.